We all talk about financial readiness for ourselves, and we hope for our spouses and our children. But truly, if you weren't here, what do they need to know? What do we need to share with them about assets that they may or may not inherit? Because believe me, not all beneficiaries are equal. You may love them the same, but they're not equal financially, they're not equal from a tax perspective, and they're not equal when it comes to financial readiness. We're going to talk about things they need to know and consider this program today. Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Jamie Burton.
Jamie, we are so happy to have you along. She is one of our senior advisors up in the Lafayette office, was one of our students at Purdue University a few years back, has her degree in financial planning, mama of three, husband to, or wife to one, right? And, you know,
Yes.
And just a beautiful, beautiful thing. I'm very, very happy to have you along. We are talking today about timing being everything. And the reality is when someone inherits assets, that is not a time on a calendar that we can simply sit down and say, today is the day, right?
Right.
This is one of those surprise, right? And as we've talked about on other shows, you know, sometimes people think they're getting nothing and get a lot. And sometimes people think they're getting a lot and they get nothing.
Mm-hmm.
And it doesn't usually go like you hear it on TV where they were just left out of the will. That does happen. But it's usually when somebody says, hey, you know, I'm leaving you a lot and they've got $10,000, but it's a lot to them, right? And then there's other people, we've had people inherit more than $1 million and have no clue that $1 million check was coming. Mm-hmm. And in some cases, even more than that. And you may say, how is that possible? Welcome to the world of 401ks, 403bs, and diligent saving mixed with compound interest. But I'll leave that alone. Let's start with this, Jamie. When someone inherits an asset, how are they taxed?
Well, it depends on what they inherit exactly. So, you know, sometimes they will inherit some life insurance. So we know that taxes are not owed on life insurance. But then you have some people who will inherit a 401k or an IRA, and that's a totally different story. They're going to be taxed.
So let's break this down into a couple things because, again, it's an age thing. But in the state of Indiana, we used to have a state inheritance tax.
Okay.
A lot of states still have that, okay? In Indiana, we have no inheritance tax from a state side. Mm-hmm. So when we're talking about inheritance and taxation, there are two parts of this column that you really need to be aware of. One is what is the inheritance tax or the estate tax, as we would call it at the federal level, that's owed, right? And then the second one is what is the income tax that it's owed. So let's go back to this and let's say you and Chad inherit the family farm, right? How much do you owe the state?
0.
Okay.
Yep.
How much do you owe the federal government?
So the federal government right now has, it's called a federal inheritance tax. So each person has an exemption of $11.5 million. So each person can leave assets up to $11.5 million, and there's no estate tax owed.
So if the family farm, if your mom and dad were killed together, killed at the same time, and the family farm was worth less than, you know, let's just call it $23 million, right? Then you and Chad would owe no tax.
Correct.
Wonderful. Now, folks, that does go back when the tax code sunsets at the end of 2025, right? And there'll be changes that are made between now and then, but that sunset would take that number back to about 7 million, somewhere in that vicinity between the two. So we're not out of the woods yet for a lot of people. There are a lot of people that would not have a federal estate tax liability at all today that will have then, either because assets continue to accumulate or because they already are above 7, but below 25 or 23 or whatever the number is, right?
Yep.
Okay. So now all of a sudden Chad dies and you inherit his 401k.
Yeah. So when a spouse inherits a 401k, there's two options. They can either change the ownership and take that 401k as their own, and then they would start following the rules based on their age for required minimum distributions and things like that. Or they can inherit it and take it as an inherited 401k. And when that happens, they would start taking required minimum distributions right away based on their age.
Perfect. Right? And why would I ever do that? Why would I not want to put it into my name or your name?
So it's really based on your age and when you would want to start taking the required minimum distributions. If you were at a point to where you didn't need that income and didn't want it hitting your tax return, then you wouldn't want to turn on the required minimum distributions right away.
Well, remember with the Secure Act, though, it's a little bit different now, right? So if you were 55, right, and Chad died, I've got to empty the account, and you kept it as an inherited, not as a spouse. I've got 10 years to pull the money out, right? I mean, so really from a planning standpoint, things that I have written about, this is one of the problems with writing them. It's one of the problems of doing a radio show for 20 years. Some of the things that I've said in the past, I'm not 100% convinced I would simply give you the same answer or I would teach you at Purdue. This is why you didn't have to buy the $240 textbook, right? Because every semester I taught at Purdue, I had to correct myself, and it wasn't over something that I was wrong about. It was over something that changed, and you just can't change what's in a book, right? They don't update it all the time. This is the danger of people going on Google. So there is different planning that's involved if somebody passes away and you've got a tax-deferred asset. One other thing that I will give you that is not a typical and maybe not even a politically correct comment. I have 2 daughters. I have a beautiful wife. She's 54. If I die, I do not want my wife spending the rest of her life being single if she doesn't want to be, right? She assures me that that's not a problem. However, right? I don't want that to be the case. But I do want to make sure that the money that I have saved and accumulated, and for many of you listening to this, your largest asset far and away is what's inside of your 401k and your IRA. So in your 401k, your spouse can sign off that they are not the beneficiary. You need to be aware of that. They can sign off that they're not the beneficiary after you're married. It cannot be in a prenuptial agreement. Do not listen to any attorney tell you that. Federal court, Department of Labor have both made this very, very clear. A prenuptial will not hold in a 401k or a qualified agreement, right? Now, in an IRA, that's different. If something happened to me and Barb is entitled to half, regardless of what I did, of the overall estate, but not necessarily of the IRA, right? So if there's an issue where I want to make sure that the girls get money, my daughters, right, and I want Barb to be able to be remarried, I don't necessarily want her to have the ability to change the contingent beneficiary, or to change the beneficiary, because if it went into her name, she is the beneficiary. She now controls it, right? And it could easily be somebody down the street as opposed to my two daughters, right? These are things you need to consider inside of legacy planning that people really don't want to talk about. Sounds very not appropriate, but it is real. I mean, this is real stuff that we see inside of the office. So,
yeah.
So, and then we've got, so we had the family farm, we've had the IRA, now you've got a stock portfolio. Grandpa left you $1 million worth of AT&T stock, and now what happens?
Sure. So when you inherit those assets, you get what is called a step up in basis. So what that means is that what Grandpa bought it for is no longer the basis in the account. It gets valued at what the value of that stock was the day that Grandpa passed away. So that large gain in there, you no longer will owe in taxes if you were to sell it.
Ever.
Right.
However, you do own any gain that goes above that.
Right.
Right. So, and this is one of the reasons why you have to be careful with a probatable estate, right? When it takes 9 months, we just had this happen, where by the time they were able, they had a will, not a trust, so they had to go through probate. And by the time the family got the stock, it actually had doubled in value, and they wound up with a $200,000 short-term capital gain, right? Because nobody knew that this was going on, in terms of what happened, and they simply took out the money, divided up the family, and here come the 1099s, right? And then the marching Indians come to the office and go, Joe, what happened? Well, good news is your stock doubled. Bad news is it's a short-term capital gain. Worst news is you have to pay taxes, right? But you told me there was no inheritance tax. I didn't tell you there wasn't a capital gain, right?
Right.
Right. And so you've really got to be very, we call it cascading clarity in our office. You've really got to be careful in understanding how some of this stuff happens. But on the IRA and the 401k, the key thing that Jamie tried to give you, and I want you to take away from that, is that you don't owe income tax on it until the money leaves the account. right? So under today's rules, as long as you're not a spouse, this is high-tech stuff, non-spousal beneficiary, as long as you're a non-spousal beneficiary, you have to empty the account in 10 years.
Yes.
As the money comes out, you have to pay the tax. That is true, by the way, even if it's a Roth IRA, you still have to pull the money out. There's just no tax recognition on it. Remember, in a Roth 401k, this is why I would almost always roll out a 401k into an IRA that was Roth, almost always. You have to take the money out as a required minimum distribution out of a Roth 401k. You just don't out of a Roth IRA. But if you're the spouse, again, as Jamie said, you can roll it into your name, use the money as you see fit, provided you're over 59 and a half, right? You don't have a 10% federal penalty. Remember, you can always take an inherited IRA and roll it into a spousal IRA under the current codes, I should say. But you can't ever go backwards. Mm-hmm. So be very, very, very careful. If you happen to be under 59 and a half, do this with good guidance and planning, and understand you can do it with portions. It does not have to be in totality, right? So let's say it's $1 million and you may need money for 2 years. You may want to keep $100,000 in an inherited and take the remainder of it and roll it into a spousal to get you past the 59-and-a-half-year-old stage. Hey, if you want to know more, go to yourlifeafterwork.com or considerthisprogram.com. You can find more of our shows that are there. While you're at the website, get signed up for our Next Steps meeting. Be looking forward to meeting you at some point in time. Give Jamie a call, 800-928-4001.